Hormel has been a strong dividend-paying stock for decades, but is it dying? Let's take a look right now. Let's talk about the business first. Hormel is primarily a meat processing company, but you'll be familiar with their chilies. They bought planters, so they have a lot of dried, shelved goods as well, and they've been producing those for a long time and returning a strong dividend to the investors. Now, if we look at the chart, let's go to the chart first because Hormel has had a horrible year. So if you look at the previous high, it's about $55. We're sitting right now at about $32 as of December 29th is the time I'm recording this. A 40% decline in this stock over the last 2 years. What does that mean? We're going to get into that in just a little bit and where I think this chart is going, but that is a huge move. Now let's get into some of the financial side of things. Revenue growth did decline slightly. Okay, a little bit, not a ton over the year. Free cash flow, down a little bit. Net income, definitely down. And earnings per share, down. So all those things are not good. And you can see that there's more debt on the books than was there previously. However, $2.3 billion on a company that has a market cap of $17 billion is not a huge portion of their total market cap. So they're not really burdened with their debt right now. They just do have some debt load. They've been able to keep the shares outstanding pretty flat, relatively flat. And this is really, I think, where investors are starting to get a little bit spooked on top of everything else is the ratios. If you go back to 2016, the return on capital employed was 24.9%. You can see that hit a low of 9.6% this year in 2023. So that's not a good thing. However, based on what we were seeing there and the inflation, all these pressures, yes, we have a lower margin there, but you're still returning higher than the cost of borrowed capital. The company's not in a horrible place at this point. Also, the dividends have continued to increase, so we're not sitting flat on their dividends. If we want to know what the company is thinking, let's go to the 10K. So the company is projecting net sales growth of 1 to 3%, starting a little bit slower, and they're really looking at the third quarter of 2024 to be where that starts to come back and really start to grow again and see some more profits from their investments. Let's take a look at two articles that I've got up. I want to show those to you. So first, let's talk about a more bearish article that I've got pulled up here. And it said in the quarter ended October 2023, the company incurred a revenue growth loss of around 2.6%. On top of that, gross profit dipped to $514 million from $566 million a year earlier. Also, operating margin came down to 9.31%. We looked at that already. Now let's look at an article that's a bit more on the bullish side. Investors saw the slumping margins and dumped HRL stock. So Hormel is a defensive type of stock. It's a consumer good. It's something that people are going to go back to over and over and over again. And so it's this defensive position like a utility or anything else. Well, when bond yields go up, people tend to put the risk aside and say, I don't want to hold Hormel stock with a slightly higher return if I can just guarantee whatever the U.S. government's going to give me and not feel like I have to worry about things declining too badly. So people are dumping this stock and buying into bonds. Now, Hormel has gotten hammered over the last 18 months. The price of livestock and other raw inputs soared during the pandemic along with Russia's invasion of Ukraine. Hormel didn't raise prices on its goods enough to offset input cost inflation, resulting in temporary drop in margins. Hormel is working on that, but you can't do it too fast or it's easy to then lose your customer base, so you want to make the slow increases and try to maintain your customers while increasing your margins back to what you need them to be. So now let me give you my 2 cents. Do your own investing research. Don't go by what I say, but I want to give you my thoughts. We've seen a 40% decline in this stock. I think that's too much for the negative news that we're getting. Hormel isn't going away. I don't think you're going to wake up tomorrow and find out that Hormel's declared bankruptcy. They're not in that dire of a position. They're just being discounted because it looks like their revenue and earnings may go down a little bit compared to what was originally projected and priced in at this $55 mark. Now, all that said, if you get a bounce off of this level, which this looks like major support to me, we've got all the way back to a low from October of 17 here. This company had a huge run up. It definitely, I didn't expect it to retrace all the way down to here. I figured we would have found support right in here somewhere. Here's what I think is happening. I think we have a tough spot here and investors that are saying, all right, I'm going to accept my losses in this company. And so they're really just selling out into the end of the year. Now, I think you're going to see that people are realizing their loss and then planning to buy back in the next year and then hold again. So I think people are realizing their losses, a lot of selling pressure, but I think that in a few days here, you're going to see this thing start to run a little bit more. as people come back into Hormel. I think it's too beaten down for what the company is. Let's look a little bit at the financials one more time. If you look at the free cash flow here, if we go back 10 years, you can see it was $541 million. Now, as of last year, it's $777 million. That's not that bad. Yes, we've been flat for about 8 years. This was a really good year. If you were to kind of average out where it's been, you can see that the overall trajectory is still up, right? Yes, it's gone way up and then kind of leveled off, but overall, you're still maintaining a positive trajectory with your free cash flow, and that's really what's going to provide your dividends, your earnings, and your growth for your company. The company has purchased planters, and so they have all of the nut products that are now part of their portfolio as well with that brand. And so I just think this company, I don't think they're going away. I think they are at a very low price. Their debt to their market cap ratio is still very low. They're paying a 3.5% dividend. They continue to raise and pay their dividend consistently. And if you read in their 10K of what their statement is, they are prioritizing their dividends. The annual dividend for 2024 will be $1.13 per share, representing an increase of 3%, making the 58th consecutive year of dividend increases. So the company prioritizes this, they care about it, and they're going to continue to try to return money to the shareholder. I think you will see, as they're able to make some price adjustments, that their return on capital employed is going to turn around. I think we're going to see this thing bounce a little bit, and so I have picked up an increased position. I had a very small amount of Hormel that was kind of just paying me some dividends in the background. Yes, it did not do well this year for me, but I definitely moved in fairly large when it hit this $30 mark. I just think this is too low for this company, and I think it's going to have a bounce. That's my opinion. Tell me what your opinion is. Do you like Hormel, or do you think it's doomed? Comment down below. Let me know what you think. Talk to you next time. Thanks for being here.